All right, with so many central bank decisions and data points out there, how are the markets positioned? Let's check in with Camara of Vanda Securities. Hello there.
Hi, Chloe. Good to be here.
Yeah, we actually had a deal, debt extension deal over in Greece, but it actually doesn't feel like it. Am I the only one feeling like this? A little bit queasy?
Well, I think the agreement between the Eurogroup and the Greek government this week is a step in the right direction. There's obviously some concerns of whether the Greek government will be able to fund itself in the next coming months. There's 7 billion in bond redemptions coming in March and April. So there's obviously some concerns there. I think the ECB and the European institutions in general will stick to its usual self of damage limitations. So if there's any pressure on Greek financing, they will either reinstate the waiver on Greek government bonds, or they'll raise the cap for the Greek government to issue government bills.
But why are so many actually raising the odds of a Grexit? In fact, much more than the previous crisis in 2012.
I think the market's actually more relaxed. If you look at how different asset classes have reacted to the news flow in Greece, you've seen almost no reaction from government bonds in the Eurozone. Even the currency has been fairly muted in reaction to what's happened in Greece. So I think the market's fairly cognizant that there's no real risk of Grexit.
I think the answer is QE. In anticipation of what could have been a problematic period of time, the European Central Bank announced QE, and it's very different to be afraid of a fire when there's no fireman around. And when there's a fireman standing by with a hose full of liquidity, let's say, that certainly helps the process.
Yeah, so in terms of market positioning, does this mean that 4 months from now, if tensions rise again over the fate of Greece, it's going to be all okay?
I don't think so. We've seen one clear thing since the beginning of the year, and that's that there's been huge amounts of inflows into European equities in the first two months of the year. We've seen most of those inflows have been targeted at German equities.
Yeah. So does that spell more upside for the DAX? And even for the German government bonds?
I think DAX has been outperforming for the last 3-4 months. It's pretty rational because there's a lot of cyclical equities in the DAX index, and those equities tend to do well in an economic recovery like the one we're seeing in the recent weeks. We've seen economic data doing pretty well. We've seen PMIs rising. We've seen an increase in M3 and some of the credit data. So I think the first rush of liquidity has been people trying to catch the QE train. But there's a stronger story behind this, which is the European recovery. And we saw that in 2013 when Europe experienced a short-lived recovery. The rally in cyclical equities was pretty strong back then. It lasted about a year, so we expect something similar to happen this time around.
Yeah, right. So everybody's trying to catch the ECB train. Is there any reason to think that the BOE train might take off?
It's been very, very difficult to read the BOE. I think it's a tough game for the central bank to play because there's a very uneven development within the UK economy, and you can see how things change in terms of probability of rate hikes. The way the US has been moving, yes, it's going to be June, it's not going to be June. I think there is a period of that coming up in the UK, which is not going to be helped by a general election as well.